Welcome to our Ask an Expert show, where I invite a fellow professional to come in and talk to me about the issues we think Brits in America need to be aware of if they are going to thrive here. My guest today is Mark Maurer. Mark is the president and CEO of LLIS. LLIS is an insurance broker, but critically, LLIS only work through fee-only financial advisors, such as Plan First Wealth, and I'll explain why that is such an important distinction shortly. So I've asked Mark to come in onto the show today for two reasons. One, to simply discuss and introduce the American insurance and annuity market. It's very different to the UK, and I'm sure most other places, and I still find it bewildering after nearly a decade here, so I can't imagine what it's like for clients. And secondly, because I am sick of seeing insurance, particularly permanent insurance and annuities, abused and missold. I see it every week in my business, I hear about it constantly, and I asked Mark to come in and help us decode some of this stuff, to help us understand what's legit, what's not, and hopefully help our listeners avoid some of the traps I've seen others fall into. So without further ado, let's get into this. Hi, Mark. Welcome to We're the Brits in America.
Richard, thank you for having me.
Mark, before we get into the good stuff, just give us a bit of a background on you and LLIS.
LLIS is 26 years old. It was started by Judith Maurer, who I call Mom when we're not in the office, and working with fee-only advisors, helping with permanent life insurance. Over the time we've added working with term insurance, disability insurance, long-term care, annuities, which as you and I talked about before, annuities mean definitely something in the UK for the most part than they do over here, and expanding all those things. So advisors who have clients with existing policies, we review those to say, here's what they have and is it any good? Or using our other example, client needs $1 million of life insurance. There's 5 or 6 different things that will be $1 million death benefit. But what are the intricacies? How much do we want to have it just be life insurance? Do we want to make it cash value? Do we want to have investment components? Do we want to add long-term care riders? All these things that the more complicated you make it, usually the more it costs.
Right, let's talk about insurance and annuities. Right, so we just want to set the scene here, because I'm going to come across very skeptical to everyone listening, and I'm sure it's going to trigger a few people. I am not anti-insurance and anti-annuity. I mean that in the very narrow definition of what I mean when I talk about insurance and annuity. So for me, a Brit coming over here, insurance is essentially term assurance. Yes, there's whole of life in the UK, but most people were thinking about term assurance. I'm a big fan, got lots of it myself. I'm organising another policy right now through you guys, so keep adding to it. And annuities that I am familiar with, which is just very simply, you have a gob of money and you give it to an insurance company, and they promise to give you an income for life.
Right.
That's an immediate annuity. Huge fan of these. That was insurance and annuities for me. And then you come to America and, I've been inundated, and so have our clients, with permanent life insurance, index universal life, and annuities, which mean something completely different and are hideously complex. So help us understand the insurance and annuity landscape.
That's a lot.
That's a big one.
That's a big one.
Yeah, I realised I was saying that. I realised. Yeah. Oh, and by the way, please make it really simple and do it in a few minutes.
You got 35 seconds.
Yeah.
Okay. So yes, term insurance is what we probably work with advisors, their clients, 90+% of the time. You have a death benefit that lasts for a certain period of time. There's no cash value. There's no investment component. It is a pure form of insurance, like our health insurance, our homeowners insurance, anything that says I'm paying for this each month, and if I die, somebody gets $1 million. And I hope that I don't need it. And so I'm going to lock it in for 10 years, 15 years, 20 years, till my kids are out of the house, till college is paid for, till I get to retirement age. And by working with fee-only advisors who are managing the investments and debt repayment and all that, we hope that it lines up perfectly, that my 20-year term policy expires in 20 years. I have enough in assets, savings to live, and I don't need the life insurance anymore. That's sort of the ultimate goal. Then you add in all the other types of policies, which are the same death benefit, but it might add some investment components. So you have a whole life policy, you have a universal life policy, variable universal life policy, index universal life policies that all have the same $1 million death benefit, but now we're adding the fact that I'm going to pay a lot more in premium, but I'm building up some cash value inside of these policies.
A lot more in premium, right?
Mm-hmm.
And the premiums don't stay static, do they? Premiums increase as you get older.
So with a whole life policy, you have a fixed premium for the rest of your life, but it's fairly high because you're paying more now when you're young and healthy, kind of to offset the expenses of this policy when you're in your 80s and your 90s. Any of those permanent types of policies are going to, because if we think of a term policy and a 45-year-old gets a 20-year term policy, the odds are that they're going to outlive that term policy. They're 65, right? That's why we have the insurance, just in case. But if you have a whole life policy that says this is going to be around for your lifetime, the insurance company is planning on paying it out. Where a term, they're assuming that you don't. So by...
Can I just be an insurance nerd for a minute?
Sure.
Do you have the difference between insurance and assurance over here? Is that a thing?
No.
So
I don't know this.
So in the UK, and I don't know if it's like an old English thing, but in the UK, it's actually called life assurance and life insurance. And life insurance is for something that may, fingers crossed, won't, but may happen. And life assurance is for something that will happen. It's guaranteed. We're guaranteed to die.
Right.
So it's
right.
life assurance. But obviously the US, when the first settlers came over here and started the nascent insurance industry, they were like, well, let's do away with this. We'll complicate everything else, but we'll do away with this.
We'll make annuities not what annuities are anymore. So.
Yes, right. It's these permanent ones that have. These are the ones that get all the attention,
right? And they get the attention because they have the high premiums and because they may have surrender charges, which say that in the first few years, if you want access to your money, there's some limits on how much you can get back. And those are the ones that people put in the $5,000 for a few years, realize that maybe that wasn't the best option. They can't afford them anymore. And they've put in $20,000 in premium and might get back 5 or 6. And nobody likes that. So that's one of the reasons that sometimes these get a bad rap, is they may or may not have been appropriate in the first place, and then by the time somebody figures that out, there are these penalties attached to them.
They get a bad rep as well because they're kind of positioned as like, oh yeah, don't waste your money on term assurance.
Mm-hmm.
Well, I really is a stretch considering term assurance a waste. Like considering your car insurance premium is a waste. And it's marketed as like, if you're throwing away money on term assurance when you could be building up a cash value in it, without really explaining that, that's a very oversimplistic way of positioning it, but it feeds into this very human desire of ours not just to be what they perceive as setting fire to money. It's not. We know it's not. You know it's not.
Right.
But it preys on that.
Mm-hmm. And part of it goes back to not that many years ago, decades, but we didn't have the options that we do now, where everybody has a Fidelity, a Vanguard brokerage account, E-Trade, Robinhood, all of these things, your 401ks, IRAs, 529 plans. Not too many decades ago, you either had your money, the average person had their money in the bank, in a savings account, maybe a CD, or a whole life policy. And most people didn't have access to all the different investment options that we have now, which once you start making things, you separate them out to almost the core of what they are, they all become more efficient. So when my only two options were a CD at the bank or to put some money in my whole life policy, it was a form of forced savings with the death benefit, which was better than nothing. But then we introduced term, and now we can separate them out. And now I've got 529 plans for my kids and my 401k with matching at work, and all of these different pockets that I can say these are all more efficient for what they were designed for.
You said that to me once, and I admit it never occurred to me. Once you said it, it all made sense. When you think about the early like sales books, Frank Bettger was all it's all life insurance, and I'd never realized that they were really the first tool in the toolbox.
Yeah, and it's held over, and so some of the sales book, the playbook is still out there, and for some people it may still be a good option, but for a lot of people, since we have so many things available, on our phones allow us to do so many different things. I could probably go buy some stock right now in something I've never heard of. It might take me 45 seconds. All the things that we can do that just weren't available as places to put our money that weren't the bank, the CD, or that was pretty much what most people had.
So, Mark, what's the one that's really hot right now? I think it's Index Universal Life or Universal IUL. Assuming I'm not mixing up products here, I see this marketed as one, don't throw away money on term. Two, I think it offers access to track indices, but with flaws, ceilings and flaws, which I consider to be a flawed concept. Easy sell, but flawed concept. And then there's a whole pay yourself tax-free, infinite banking, stuff that people but I've been in meetings when people have got this stuff and they say to me, yeah, but I can take from this tax-free, can't I can just create a tax-free income. So help us understand what's going on with these things, what they are, and what's going on.
So let's talk about sort of the crux of over here, the tax benefits of permanent life insurance. So when you put your premiums in, it grows on a tax deferred basis. So I don't pay taxes along the way as I have earnings. At some point in time, if I've built up enough cash value, I can take withdrawals of my cost basis. So all that premium I paid in was with after-tax money. So I can take that back out tax-free first. Then what I can do is I can take loans against my gains and not pay taxes on those. So I took out my tax-free money first. Now I'm taking loans against what would be otherwise taxable if I just cashed in the policy. And as long as the policy stays in force at my death, my beneficiaries get a tax-free death benefit. Now, it might be really reduced if I took all the money out, but I can do...
And you have to pay the loan back out of the death benefit first, presumably.
Right. So the loan is paid back from the death benefit. So it may end up with a $5,000 death benefit after paying back the loan, but as long as that's a positive number, there's no taxes due. Now, all of that takes an amazing amount of timing and maintenance to make it work. So I think that's sometimes where it goes wrong in the first spot. The projections, all of these things are based on projections, which are either based on, if it's a variable policy, investment performance, if it's an indexed universal life, the indices performance, even a regular universal life or whole life has some dividends or interest earnings. So things that somebody projected in 1982 aren't going to work today. Because in 82, they thought we were going to have 6%, 8% interest rates every year. Not almost nothing for a decade. So there's just maintenance and ongoing things that all these things have to be revisited. And I think that's a big problem.
Someone sets a policy up in the 80s, and they project forward based on interest rates of even double-digit interest rates. We then have years, a decade plus, like where we have none, right? So the policy's not earning anything; it's not growing. Meanwhile, your premiums are increasing. Is that right? On growing, so your premiums, unless you're paying them out of pocket, they start eating the policy essentially.
Right. So all those. The sort of the internal mechanism of a life insurance policy is you put in your premiums, you add interest, and you take out costs of insurance every year. When I get older, my costs of insurance are increasing every year, but I'm hoping that then my cash value is growing on the other side to offset that. When I have lower interest rates than what I thought, my costs of insurance are still going to go up, but I have less money in the pot to offset those. So yes, instead of, if I was paying $10,000 a year and assuming a 6% interest rate, I was going to have blank at age 65, and it ends up being 4% interest, I'll have less because A, I have less earnings, and those costs of insurance still keep coming out. So sometimes people think when I get to 65, I can start taking loans of $10,000 a year. But if nobody's looked at that for a while, they'll start taking those loans and realize I don't have as much cash value as I thought I would to allow me to take out that much. We're almost projecting or talking about things that happened a long time ago or issues with what's in the future. But even those kind of subtleties are what make these surprises for people of that, well, I thought I could do this based on an illustration or a proposal I saw 20 years ago. Most of us don't check on these every few years to see, is that still working? We just kind of think, well, I paid my premium, so that's what's going to happen.
So you can have a situation where people are paying the premiums, but the cash value is still going down, right? Because the premiums aren't meeting the cost of the insurance any longer.
Right.
Then and then what happens if they basically can't carry on paying the premiums and or they eat all the value in the policy? Let's say they have taken out let's say someone's got used to taking out $10,000 a year in a tax-free loan, but 20 years later in the mid-80s, it's not sustainable anymore. They can't keep it going. What happens then?
So either the policy lapses, falls apart. There's zero kind of total cash value, and the policy lapses. And if there's any taxable event at that point, they get a 1099.
Sorry, Mark. Just so I've taken all the growth out, right, as a loan. I've not paid any tax on it.
Right.
I can't maintain the policy anymore.
Right.
It lapses. I get a 1099 for 20 years worth of withdrawals that I thought were tax free.
Right.
Because they were a loan. And I haven't got the money anymore because I've got no money left in my policy. Is that?
So yes. So that's one of the problems. That's sometimes we do policy reviews where that's almost the situation, and people took we call it a snowball rolling downhill. If someone takes a $10,000 loan 20 years ago, that loan may have been charged 8% interest for the last however many years.
Wait. So on that example before, I said 20 grand, 10 grand a year for 20 years, 200 grand. But each tranche has got its own rate of interest applied to it. So the first tranche has got 20 years or 19 years at 8%. The next tranche has 10 grand has got another 18 years at 8%, and so on and so forth.
It just adds. It's just It's just a giant loan balance growing. So that $10,000 a year is.
Wait, so does that mean the income then is going to get assessed at like that? For, more than that as well. It won't be the two. You won't.
That just depends. That depends on how much gain there was in the policy at that point. But we hope, yeah. But what we hope is either person passes away before it gets to that zero, because the nice thing is that then there's no tax due.
Well, right, Mark. So one of the things we hear though is, but that you're paying yourself interest. This is the whole infinite banking thing.
Yes.
Yeah. You get to take out money tax free, and there's an interest rate, but you're paying yourself rather than a bank. Is that accurate?
So let's take a loan. We'll do our same example. I take a $10,000 loan against my life insurance policy. In the most favorable situations, then that $10,000 goes into a side account. And that $10,000 in one pocket is going to earn, let's say, 3%. At the same time, the loan balance is going to be charged 3%. So my $10,000 in my left pocket grew to 10.3. In that pocket, in my other pocket, now my loan balance is 10.3. A lot of policies, you pay more for a loan than that other, so that's called a wash loan or preferred loan. But I still, if I wouldn't have taken that loan, I would have 10.3 in the side and not a loan. So at that point, I almost zeroed out any earnings as compared to having kept it in the policy and earned $300 and used something else.
It's not necessarily as good as it sounds.
Right.
You're not.
Right.
You're not paying yourself.
Right. I didn't pay myself interest. I didn't make money. Richard, if I give you a loan and say, I loan you $10,000 and you pay me $10,300, I made money. With a whole life policy or any type of loan, you don't really earn the most favorable is you didn't lose money.
Just before I get into the uses of it, I also want to talk about one of the other things that I see this being sold as is people are understandably skittish about markets. Markets go up, they go down. Over time, they go up by more than they go down. We've got a lot of history around that. But there is and always will be a market for smoothing those returns, or protecting from the downsides, however temporary.
Right.
And this is where I see it coming in for these types of life insurance, index life insurance, and the like, is where the performance will be linked to a stock market. Let's say the S&P 500,
right?
And it'll be capped, I don't know, at 8% a year, but it can't go down, and people love that, and I get it. But what I do think is dramatically misunderstood is the true impact of that over a long time.
Mm-hmm.
Because people think, 8% is great, I'll be happy with 8% a year. But what people don't understand is, while stock market returns may average 8-9% over 30, 40, 50 years, the reality of it is all that growth comes from a couple of years that are at 20%. Markets, on average, the S&P goes up 3 out of 4 years. 1 year it goes down. 1 year it goes down, you're not losing any money that year.
Right.
But another year it goes up, but it's like 1%. The other 2 years it goes up like 20%. So people don't understand how much they're leaving on the table with that. And I don't necessarily blame the insurance industry for coming up with a product that meets some people's needs, because it is good that people are investing, and some people do need a little bit more protection than you can get from stock market investing. And I'm a stock market investor. That's what I do. I am biased to that respect, but I do understand that there is a need for an array of solutions. Some people just aren't emotionally equipped for it. That being said, I think it's overdone. I think it's oversold. I think it's overplayed. I think it's overpositioned as like protect yourself from downturns. And I see people who do have the emotional fortitude to invest leaving good money on the table because they've been sold on never goes down, tax-free withdrawals, don't waste money on term insurance, and it just kind of winds me up.
I don't disagree with any of that. You're absolutely right. You have your 0 and your 8, but you need to participate in the 32s sometimes.
Yes.
And unfortunately, sometimes the negative 12s, but you have to get those plus 32s to get that 8% over 6% over the long run. And the way it was explained to me one time is that if you put the money in a regular universal life policy, and let's say it's 4%, you'll earn 4% for the next year. It's not going to go up. It's not going to go down. Insurance companies, what they're doing is they're taking that and basically buying puts and calls, hedges on these different indices. And you can't, if it's worth 4% now, you're sort of hedging the 0 and then some potential upside. But on average, you can't get blood from a turnip. You can't say, I'm going to basically give you lots of good ups and no downsides without it costing something. So exactly. Over time, I read something that said on average, an index UL might have 1.5% return more than a fixed policy, because you're just trading the cost for those hedges. There's no free lunch. It can't be too good to be true. And a 7 or 8% in a cap in a 7 or 8% environment looks good. Like you said, in a 15%, it's okay. And next year when it's 1%, I got 1. I didn't get 15 and 1. I got 7 and 1. So it's okay. But it's a way to illustrate market-like returns on a policy that is not subject to security, variable policy that really does invest in sub-accounts. There's a lot more scrutiny, a lot more steps, a lot more licensing that has to go through it. An indexed UL because there are sort of those caps, those safeguards, but you're not actually investing in it. is different, a whole different set of licensing than a true variable policy.
Mark, I don't really come up. I don't really see variable. I just I see indexed IULs. That's what I see, and I believe it's because it's an easy sell, and I believe it's missold on that basis.
And you had zero is your hero and some kind of neat catchphrases on it. But yes, and for some people, maybe that is, as you said, the only way that they might be able to A, have life insurance, B, have something that's going to outperform a 3% interest rate. But I would say for most people, especially those with financial advisors who can say, put premiums here for this goal, here for this goal, and just low premium over here for term insurance for death benefit protection makes more sense.
Right. So, Mark, before I get back on my high horse and start railing about annuities, let's take a breather from me trashing all things permanent life, all things, and let's talk about the actual use cases. Now, I do want to stress, like I've been pretty negative on this stuff, and I think I stand by that. Just from what I see day to day, and also what I hear about how other people use this stuff. What I see day to day is when we take on a client who's got an IUL, I always wish they hadn't. I just don't think it's fit for purpose for them. Now, that being said, though, that's 9 times out of 10. I know there are use cases. Mm-hmm. Permanent life insurance. Talk to us about the use cases, the actual use cases.
Who knows what estate taxes are going to be? But estate taxes is still an issue for some people. Not near as many today as it was in the past. But having permanent life insurance inside of usually an irrevocable life insurance trust to help offset estate taxes due at death is still valid. Sometimes permanent life insurance for equalizing an estate. One kid, the majority of somebody's wealth is in a business or a farm. One kid runs the farm and one kid does something else somewhere, who knows where. You don't want to have to sell the farm so that kids can get their half of the estate. So life insurance can do that at death. People with special needs children, where the kids don't have necessarily a shortened life expectancy. We use permanent life insurance, sometimes a second to die policy, so that when, as parents, we care for our kids and we do it all for free, and we do it when we're tired and even when we don't want to. And so as long as one parent is around, they're going to care for those kids, even if mom and dad are 80 and the kids are 60. You just will. But then when both parents aren't around, now that care needs to go to somewhere else. Is it a facility? Well, you need money for that. Maybe it's a sibling, but the sibling has their own life. Maybe they need to move to be able to accommodate a special needs sibling at that point. So permanent life insurance comes into play there when someone, you have the two parents and no parents are alive anymore and somebody still needs care. And some people just want it. To your point, an index universal life policy that's being sold as an investment probably isn't usually the best fit, but there are people who have permanent life insurance. I come from insurance people, so I know that my parents have some that goes eventually to my brother and myself. I have a little bit of permanent insurance for my kids. The majority of what I have is term because I don't want to spend that much money on it. I want the low-cost term and do all of my saving and investments, and be able to maybe make gifts to them while they're alive, when they need a down payment on a house, not necessarily to leave them, kind of leave kids a bunch of money when they're, with the way we live, parents are dying at 90, 95, their kids are 60, 65. You need money when you're trying to buy your first house. You don't need it when you're basically retired. Like, great, thanks mom and dad, but I really could have used that when we were, had to renovate our house. So for the most part, sometimes people want it. They might have been the beneficiary of a life insurance policy at one point, but then that's where advisors or we can come into sort of the situation and say, here's what you really need. Or somebody showing you $1 million policy. Maybe maybe it's 100,000, maybe it's 250. Sometimes our jobs, I'm sure you know, is clients have something set in their mind. Sometimes if we tell them no, 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 eventually they're going to find somebody who will sell it to them and will sell them the $1 million whole life policy. Sometimes our job is say, I really hear that. I think 250 would be a good set based on your budget and all these things.
Or heaven forbid, they've seen someone on TikTok who in front of a flip chart, always a man in front of a flip chart, drawing LLCs and trusts and lines and life insurance and telling them how that's how the secrets of the rich and famous avoid paying income tax.
Yes.
Oh God, the stuff that's going on online, it makes your toe curls. Your toes curl.
Yes, and we're more vanilla when it comes to life insurance. Term insurance, there's a few scenarios where permanent insurance makes sense, but for most people, I think the cost of it as compared to term and all the other investment options we have, they're better off with term.
And this is why financial advisors come to LLIS, right? Because that's our belief and our way of thinking. Okay, so if you look, it's a tool in the toolbox, right. But it's a Phillips head screwdriver. It's not a mallet. It's not a hammer, and it's used like a mallet. So, right, let's give everyone a break from life insurance, and let's move on to the illuminating topic of annuities. Annuities for me, as I said before, big fan. But for me, an annuity is an immediate annuity. You give an insurance company a load of money, they give you a guaranteed income for life. Ideally inflation linked, but that's not as big a thing here. And I moved to America, and annuities are investments in their own right.
Right.
With loads of riders and stuff, and I found it all very bewildering. Now, I'll tell you what really annoys me the most about annuities is when I find them really convoluted and complex, with all these different riders and stuff. And an annuity to me is in its essence, is such a simple product. Just like, as I say, swapping a lump sum for a guaranteed income. Whenever, and this is without fail, whenever we've taken on a client who has already got an annuity, we always groan because in the fact-finding meeting, they will tell us what they think they have got. And when we actually get it and open up the bonnet and look at what's going on, it is nothing like what they think, and it is never better.
Mm-hmm.
And that really winds me up. They're locked into these things.
Yes.
They think they've got this great, fantastic guaranteed income. It's never as good as it looks. The inflation linking of it often isn't a thing. Maybe that's just a cultural thing. It's so embedded in it, as in the UK, that's a critical piece of it. And maybe so, but there's just all this stuff is hidden behind bells and whistles, but the result is never as good as it should be, in my opinion.
And you're right. We annuities, the core is that here's an insurance company, here's the money, pay me an income stream for life. You read old books and people talk about, giving their servants an annuity or, all of these fun things. And that's all it was. Now we've added it where it's not necessarily an income stream, but it's another tax deferral vehicle like life insurance. You put in a lump of money, it grows on a tax deferred basis. Now with an annuity, your tax treatment when you start to take money out isn't as favorable. You take out your gains out first. There's no loans. When you die with an annuity, it can pass to your spouse tax-free or not as a non-taxable event, but if there's any money left over and you leave it to your kids, they're going to owe tax on the gains. So it's really the best part about it is the tax deferral in life. As you said, now we can add guaranteed lifetime withdrawal benefit riders and guaranteed minimum income riders. And
Mark, just taking it back for 1 second.
Sure.
So tax deferral, because I do often it's positioned as that. So you
yes,
$1 million, put it into an annuity, not into a brokerage or whatever, because you get tax deferral, right? Great, yeah, you do. But correct me if I'm wrong here. You turn your 1 million into 1.5 million. You've not paid tax along the way, but when you if you do withdraw it as a lump sum, let's say you dissolve the annuity and you pull out your 1.5 million, that 500,000 now is taxable to income
Correct.
tax rates.
It's
So,
income.
so yes, you've deferred it, but your tax rate on that income is going to be way more than it would be for capital gains.
Right. Yep. 100% taxable as ordinary income. And let's say I just wanted to take out some money. The first 500 I take out is going to be all taxes first. So I take all of my taxable money out first, and then I take out the basis.
You can't manipulate that in any way. You
Nope.
can't say I'll do 50% basis, 25% growth. It's 100% income.
The only way you could would be to annuitize it to our income stream. Now, when I do it as an income stream, then each payment is part gains, part basis. But if I just kept it as that, if I just kept it as that growing annuity, when I start taking $100,000 out, my first $500,000, all taxes up front.
Well, I did not know that. And can you always annuitize? So if I've got 1.5 million with, let's say, AXA, is there always an option to it? Even if I haven't selected it at the beginning with one of these riders that we'll talk about, is there always an option to annuitize? And do I have, in the UK we call it an open market option? Can I shop around to other providers other than AXA, or am I stuck with AXA?
No, you're yes and no, or no and yes, depending on which one I'm answering first. So yes, every annuity is going to have some built-in annuitization table. So you can always call in and say, what would, if I wanted to turn this into an annuity, immediate annuity, we call them immediate annuities here. Immediate meaning that payments start within the next 12 months. So I'm going to turn it into an immediate annuity. It's going to start paying me the X amount per month. What are AXA's rates? And they're going to give you their rates. But then we can also look at other providers, and there's what's called a 1035 exchange. A 1035 is a section of the Internal Revenue Code that says we can transfer those cash values over to a new annuity company. The cost basis transfers over, the taxes transfer over, no taxable event transferred, kind of like rolling an IRA from one provider to another. All of the parts of it transfer over. So if Integrity or Principal or Prudential or whoever has better annuitization rates, then that's an option on the table.
I'm more okay with that. That makes sense. As long as the annuity itself for the 10 years or 15 years I had it beforehand isn't overly expensive, because there's different fees on these wrappers, and that you have access to a decent investment options underneath.
Right. And even with annuities, you have, like our life insurance, you have fixed annuities, which says we're going to pay you 3.5% for the next 7 years. No more, no less. You have variable, where you're picking the mutual fund options inside these annuities. And you have your good old indexed, we have our old indexed annuities too, where instead of getting 3.5% fixed, it might have a floor of 0 and a cap of 4, or a cap of 4.5. Long time ago, you would see caps of 5, 6, or 7% on annuities. One of the, I guess, sort of my pet peeves about the index policies is that the indices, those caps, can change. So even though I get a policy or get an annuity with a 7% cap, next year it could be 6% or 6.5%.
Yeah, right.
So
it defeats the purpose.
That I would probably change my tune on index policies if I think those things could stay the same, or change my tune a little bit. Maybe not 100%, but.
Well, so can we talk about riders then? Because what you've outlined for me before, I could kind of get behind that, honestly. Again, subject to certain specifics, but they've always got these expensive and complicated riders.
Yep, yeah. The most common one is that in anything with an income rider, and what these will do is they'll say if I put in $100,000, I'm going to sort of have this phantom account that's growing at 5%. And at some point in time, that $100,000 has grown at 5%. Let's say it's grown to $200,000. This other account says at some point in time, you can start taking income, and we're going to pay you an income based on $200,000, whatever my calculation might be, regardless of what the actual cash values are. So when clients hear, I'm definitely going to earn 5% every year, many times it's in this income account. It's not their actual cash value, not their actual money.
But they've not heard that.
They've not heard that.
I'm not doubting that's what being told to them. But the thing that's lodged in there is what you're saying is this 5% a year guaranteed to get this amount back as income. That's what's lodged.
Yes, I've heard it on radio ads here in Tampa, where I know exactly, I know what they're saying, or I know what the type of policy they're talking about, but the way they're saying it is not exactly. It's kind of like our loans. It's not wrong.
Yeah.
But the way that you're kind of saying it, I'm not sure is the most accurate. And so those are usually, you're paying 1.5% per year for these riders.
Wait, 1.5% for the rider on top of the other contract.
Right.
The fee for the contract.
Yes. Usually that's an additional,
is a massive expense.
And so for someone, so who would it be good for? Let's say someone is 5-6 years away from retirement and has just enough money that if nothing goes wrong, we can retire. So someone would say, if we put it in this annuity, if the market goes up, great. This rider didn't really do much. But if things really go south.
Could you just go back to explaining the rider? Because I think I missed a part. So
Sure.
You've put your $100,000 in.
Yes.
That's going to be linked to whatever it's linked to, whether it's a fixed annuity or linked. But there's a separate thing going on over here, this income rider.
Mm-hmm.
And that's it's like a phantom account, right? And that's a 5% a year. Does that have a term on it, or is that just to a certain date?
Usually 10 years, something like that, but it can go on longer.
So based on this hypothetical with the guarantee attached to it, what happened? So you get to the end of that 10 years.
Yep.
What happens?
So you decide whether you want to turn on the income rider or not. If let's say I put in my $100,000, my income rider grew to $200,000. It's going to pay me 5% on $200,000 or $10,000 a year for life.
Is that set at the
And
stage
that's
as well?
set,
So
yes.
That's set at the beginning, not
Yes.
when you take the policy out. Okay,
Right.
so you're getting this hypothetical annual increase and a guaranteed amount
And a specific
withdrawal
percentage,
amount,
right.
if you turn that on. Okay,
Right.
got it.
So it grew to 200. I can get $10,000 a year if I turn this rider on.
Yeah.
If my account value my actual cash value is $80,000 because we've had a horrible market, then it's a good deal.
Totally.
If my account value is $250,000, well, then it's not really worth anything, because why wouldn't I just use the $250,000 for income?
You get to this point,
Right.
you can pick, and you're obviously going to pick whichever. But it's just that you've paid for the privilege of having that decision along the way. That 1.5% extra,
Right.
1 to 1.5%, which will have hampered your real account value.
Right.
So you've probably you've cut into that over the 10 years. Still might have
Right.
outperformed, but you've given yourself more choices. Okay,
Right.
So I mean, that's expensive, but I get it.
It's
I
expensive.
do,
Yeah.
but I can see the benefit, and the scenario you outlined there is a classic one. When you meet someone who just wants out,
Right.
They're just done. They want out. You really can't afford to, expose them to the market that much, and that is a solution.
But that's so many things I try to find. I try to find the good parts, because so many times I see it where somebody's been paying for this rider for however many years, and they said, we don't plan on using this annuity for income. And as you said, we see the opposite side.
I see people in their 40s with these, and it's like, what? Why are you paying 2.5% for this annuity? Like, what?
Right. Your in your 40s, your 2.5% is better off accumulating.
Yeah.
So to me, I think where sort of that rider, we have lots of people, well, I'm never going to use this for income. Well, then don't pay for the rider. You're in your 40s.
Yeah.
I probably shouldn't even have been an annuity in the first place, because you're probably not maxing out your 401k, or your Roth, or doing a 529 plan for kids, tale as old as time. But I think that rider for someone, it makes it very complicated. But that would be a scenario where I would say that could be, and again, that's maybe less than 5% of people. So if we say I can't find a really great fit for it for the majority of people, but I can find scenarios. Now, sometimes that will be what is presented all the time. Oh, it's always growing at 5%, and you can always turn it on for income. But when you're in your 20s and you have 2.5 decades of getting the market growth, that 2.5% really eats into that over that many years.
Really eats into that, yeah. You got me thinking. So, you said before, someone in the 40s, you just shouldn't. You have no need for this. You should be maxing out your 401k first. You should be putting money into a 529. All these boxes to tick first. Forget income riders. Just think bog standard annuity, not immediate annuity. Just putting a lump of money into an annuity. When or if does that ever make sense over, say, a brokerage account, which is going to get so let's say someone's ticking, they're maxing out the 401k, they're putting money into a 529, they're saving money in already, they've got term insurance, they're saving money into a brokerage account already. Is there ever a point where, for tax diversification or something, that an annuity just a standard annuity makes sense? Bear in mind, it's going to be taxable to income tax.
So because we work with fee-only advisors who usually are able to, and as you talked about, the taxes of an annuity when you want to take it out, it's not cap gains, it's ordinary income, it's all. So advisors who have multiple options at their disposal, an annuity usually isn't a great fit. So I would say, for the most part, I don't remember the number of advisors who have said, let's put, and I'll say, new money into a variable annuity, into an indexed annuity, just for the accumulation component. In the last 2 or 3 years, with fixed interest rates being up higher, we have seen some advisors who say, my client is very risk averse. CDs are paying 2%. I can't necessarily get them into bond funds, but fixed annuities are earning 5%. So I have seen some advisors who are very risk averse, putting new money into a fixed deferred annuity that says it's got a guaranteed period, a guaranteed interest rate, no ifs, ands, or buts. The other portion of any annuities that we work with are thinking a lot like you, partly because it's an income rider or a rollover from somebody's existing annuity, that expensive annuity that doesn't have any bells and whistles that they bought 32 years ago or 15 years ago. But for the most part, I would say large majority is either going to be risk-averse people looking for that fixed annuity, or something with some sort of income rider / that immediate annuity that's going to start paying out.
Well, this has been great. So, look, guys, this has been a really technical episode. I know we've talked. We've talked life insurance and annuities, and we've gone pretty technical. And I make no mistake. I make no apologies for that. Right? This is. I just hope that some people will hear this and maybe see through some of the messaging that they get bombarded with, and make better decisions. And I know I've been a bit negative, but I don't mean to slam the whole industry. There are really great use cases for all this stuff, and insurance and annuities are a critical piece of the financial landscape, of the financial tapestry. I'm all for that. I just see abuses. Like, one of the things I see right now, Mark, is there's a company who I believe are convincing everyone to roll their 401ks into IRAs and then slamming them into annuities because annuities pay commission. Like, that's the really, really ugly end of this. Right, that's the vast majority of people who are involved in this aren't doing that, but that is something I'm hearing a lot of, and it makes my blood boil. And then just the stuff that we see out on a daily basis is people, we just pick up clients and they tell us they've got X, and we look at it and it's Y, and Y is never as good as X.
Right.
So I hope people listen to this and they understand enough of it. But what I'll do is, when I hear people talking, I'll send them to pick this episode up and just hear from hear from relatively impartial. I know we're not totally impartial, right? We're in the industry, but relatively impartial people discussing this, the use cases, the abuses, and it can help people. So, thank you.
Of course. Well, and as you said, there's uses for it. That's why we love working with fee-only advisors, because I can talk to you and say, tell me about the clients, tell me about their specifics. A index universal life policy, like your point of a mallet, is not good or bad. But if I want to fix my watch, I don't want to use the mallet. So, or I guess my iWatch. Does anybody have watches anymore? I don't know. But so we get to work with advisors that tell me about their clients. What are their goals or plans? Where are they at? How many kids do they have? How old are their kids? What are their goals? And we get to factor in these things and sometimes say, it's working pretty well. Maybe we don't, maybe we keep with that and add term. Sometimes it's just not working at all, and we really need to free up cash flow, and we find ways to unwind them. But yeah, like you said, they're not all bad. There's a lot of good to all this, but just so many times, it feels like there could be a plan B, an option B.
It must drive you insane, right? Because obviously I'm a financial planner, and lots of the negative, lots of the accusations that are thrown at the industry are fair.
Mm-hmm.
Right, and we're all lumped in the same bracket,
right.
And it really, really bugs me sometimes, and I'm sure it must be exactly the same for you.
It is, and just how many times I think you even sort of said it. I wish I could go back 18 months and have them not do this, because sometimes with these permanent policies, or sometimes with the infinite banking, people cash in 401ks and put money into these policies that they've put in tens of thousands of dollars, and a year or two later go, I thought I could take my money out. Well, there's surrender charges, there's these penalties, you can't access it yet, and those are the ones that I really but yeah, there's a lot of good out there too. So
yeah, keep doing what you do. Right, Mark, where can people find you?
LLIS.com, or my email's Mark, M-A-R-K, Maurer, M-A-U-R-E-R at LLIS.com, or through you, or any fee-only advisors, but hopefully through you.
Yeah, well, look, I was going to say, where can people find you, Mark? Not that they need to, because they need to come to us, and we will funnel. But yeah, you're on LinkedIn, website, email, all good stuff. All right. So thanks once again, Mark. I appreciate it.
Absolutely.
All right. Cheers.